Welcome, everyone, to the Lee-Chandler Commercial Finance Podcast. My name is Marcus Baker, and I'm an analyst for the investment team. Today, I am joined by my fellow analyst, Bray McIntosh. Today, we are continuing our multi-part series on strategies that are useful in real estate investing. Real estate investing is a low-risk method of diversifying your portfolio, and rental properties can provide a good source of cash flow. Today, we are focusing on the topic of financing options for real estate. First, we will discuss the options available for 1 to 4 unit apartments, and then we will move on to apartments with 5 units or more. Bray, would you care to discuss 1 to 4 unit financing options?
Absolutely, Marcus. So there's a lot of different options for financing 1 to 4 unit properties. So let's run through them. The first type are investment property mortgages, which operate much like an owner occupied mortgage, but typically they have a little higher interest rates and the LTV can be a minimum of 20%, sometimes higher. Another common type of loan you could utilize are FHA or VA loans. The pro of using these kinds of loans is they typically don't require previous management experience, and minimum down payments can be as low as 3.5% for FHA loans and 0% for VA loans, which can be good for those without a lot of cash on hand. The con of using a FHA/VA loan is that they typically require the property to be your primary residence for 12 months, so you would often have to live in the investment property for a period of time. Also, we should note that there is a specific type of FHA loan called a 203K loan, which can give you up to $30,000 for repair of old or damaged properties that you are planning on flipping. Another common type that you can utilize of loan is the home equity loan, or also the HELOC, which is the home equity line of credit. These are loans for fixed amounts of money that are secured by your home, usually limited to 85% of equity. These have fixed payment amounts and fixed interest rates. Often the average interest rate is around 5.28%, and they use the property as collateral, which you have to know because you could lose your home if you are not meeting your payments, which is why this is not necessarily the most popular option. Another common type of loan you could use is a hard money loan. These typically have an LTV of around 50% and have higher rates than a traditional mortgage. The terms are generally short, sometimes less than 6 months, but they can be longer. Hard monies are a very wide scope of loans that are not typically bound by the same rules as standard mortgages. Another type of loan are the portfolio loans, which are loans made by local lenders typically, and they're less regulated because they are not entered into the secondary market by selling the mortgage to Fannie Mae or Freddie Mac. The banks hold on to them. So they're a little more risky and a little higher rate. Another common type are private lendings. This is a loan from a peer-to-peer lending or from private institutions, some types of equity firms. Not necessarily easy to do unless you have the right connections, though. And then finally, you could use a retirement vehicle. So for example, your self-directed IRA, self-directed 401k, or your solo 401k and utilize the funds in those vehicles to purchase an investment property. It is important to note that if you take this route, though, all the income from that rental property is going to go into the IRA or 401k, not to you personally, and you have to keep an arm's length away from those transactions. So those are basically the main ways that you can finance property purchases for 1 to 4 units. So now I'm going to let Marcus kind of touch on 5+ unit purchases.
Thank you, Bray. For 5+ units, we have different loans available. There are still quite a few different types, but a lot of your more, how does put this? Loans are typically available to the average individual, will not have enough or a large enough limit to be able to purchase a 5+ unit property. So from the 1 to 4 unit options, we still have hard money and private lending. Those are typically dealing with less regulated institutions to begin with, and they have free reign to say who they're going to lend to. Again, if you have the money yourself, self-funding your project would probably be the best, just because you're not paying out any of your profit margin in interest. Some other options that are available is a bank line of credit or term loans. Term loans are usually based on the financial income of a small business or for a large business as well. They have a fixed repayment schedule, and yeah, that'll work. Sorry. Next up, we've got commercial loans. These are typically for larger businesses because there's a lot of regulations for them and a lot of upfront cost, so most small businesses can't really afford them. But hey, if you got the money to actually do it, and you need a lot of capital for buying your, I don't know, 100-unit property or something, that'll probably be your best option. The last category we've got is syndication. Syndication is also available for 1 to 4 units, but it's when multiple private investors pool their assets together to try to buy an apartment complex or really any business. Now, of course, the terms of syndication is just up to the people involved and whatever they want to agree to for yeah, profit sharing, who's going to put up what assets as collateral. Really, it's you can make it whatever you want. Well, provided, of course, you can get someone else to agree to it. Anything else to add, Bray?
I think just one other note for syndication is that not only can you have multiple investors buying into a single apartment complex, say, you could also have in syndication multiple lenders involved in the syndication process, where perhaps one lender is not comfortable putting up $5 million for this project, but 5 different lenders are willing to put up 1 million each, especially if you have multiple investors who are putting up individual down payments and willing to cover everything. That's a big part of syndication.
That's a good point. Thank you. I did want to say one quick note for the VA loans and the FHA loans. Check the county, or should look up online to find what the loan limit is for the county. Particularly for the VA loan, each county has like uh, its own upper limit for how much you can borrow. Typically, it's in the realm of about $500,000. But high cost of living areas will usually have a higher limit. We hope this discussion helps you in your search for financing. Remember to check all of your options for the best terms and rates. If you have any questions, you can email us at investments@lee-chandlerenterprises.com. You can also check out the website at lee-chandler.net for more articles, podcasts, and webinars. Thank you and have a good day.